Hello and welcome to Movie Market Podcast. I'm JR Gondeck, as always, joined by David Sokolovsky. David, let's recap January. Kind of an interesting start to the year, some movement within the markets that probably will give us some direction where to go the rest of the year.
Yeah, thanks, Jared. January started off as a relatively good month. You had, most stock indexes perform well, but there's definitely some rotation in areas of interest that we're continuing to look at. We've had some earnings come out so far, and they've helped justify some of the valuations, but in some cases, it really comes back to the chicken and egg of, are the valuations driving or justified by the earnings, or has a lot of that already been priced in? And you continue to see international lead the way, and that may be another strong year of performance there and continued focus area. But as you look at it, S&P 500 was up 1.5% for the month. The more interesting thing to note was that this was the third month in a row that value outperformed growth, and you continue to see the shift out of some of the momentum and some of the tech names, and you've seen value outperform growth by 10% over the last 3 months.
Well,
Um,
David, I think even more importantly, growth is negative 3 months in a row as well.
that's right. Yeah. So outperforming, that's a good point. Negative 4% versus positive 6, right? But as you said, it's 10% outperformance. And even in the month of January, it was a nearly 6% outperformance just because of some of that shift. And as we talk about like the S&P 500, for example, we've talked about this for a long time. If you have a handful of names that represent a significant portion of the overall index, and you see some of those names start to slide, the balance of the S&P 500 is, held up relatively well. And so that's where you're starting to see some of the shift from, the Mag 7 to the everything else.
And as you look at the economy now, right? Solid footing for the most part. Fourth quarter GDP still, solidly in the fours. We'll get the final number next week. And no reason, with earnings and company outlook so far to expect a drop off in the economy this year. The big news, toward the end of the month after the Federal Reserve meeting is the new Fed chair, Kevin Warsh, likely to be the next Fed chair, which is interesting. And the markets were very concerned about maybe the independence of the Federal Reserve and other things. And Kevin Warsh, having been on the Federal Reserve before, and maybe not even on necessarily on the same page as the Trump administration as far as cutting rates. He's concerned about inflation and other things overall, and is pretty adamant about the independence of the Fed. So it'll be interesting to see how that plays out. You saw the dollar, recover toward the end of the month, early February. You saw a whipsaw through commodity markets, currency markets, nonetheless, which I think will be interesting to see. But as you look at it, David, the big thing on the Fed's mind, right, with the economy seeming on solid footing, inflation okay, labor market is really the key focal point, I think, for the Fed for the next few months ahead to decide if and when to cut rates.
Yeah, Jared, I think, as we've seen inflation, it continues to be a mandate, but it's not an area they're probably looking as closely as they're watching labor. So let's talk about some of that. So as you kind of look at labor, and this is ADP employment, you also have government job data, and that's been delayed because of the government shutdown. That will be released next week. But if you look at it here, you have two lines. The blue line is the overall labor force. The orange line is the job growth. So essentially, if you're adding up, the changes in the orange line, it's what drives the blue line. And as you've seen, the blue line continues, the labor force continues to expand. The pace has certainly slowed, but still have a healthy labor force overall. As you look at the job growth, and you can see, in early 2025, there was some negative job growth. It ultimately recovered, but as you look at these numbers, the average is, at around 50,000 or maybe slightly below that. But the job growth has just not been very exciting. You don't see a lot of new jobs being created. And as you look at different sectors and and areas, you've seen a lot of white collar jobs, a lot of programming jobs, a lot of financial services and the like. Um, be tapered. You see areas of growth in leisure, hospitality, some healthcare areas, some some other areas as well. Larger employers, having a little bit more cuts. So as you look at the economy and just the overall labor market, somewhat uneven. On the other hand, when you look ahead to people who may be losing their jobs and unemployment claims, continue to be, I guess, in the so-so range. But the continuing claims, it seems like people who are potentially losing their jobs are finding new work. right? And so you saw a little bit of a slowdown in 2025 as that continuing claims number ticked up, but then you saw a lot of those people kind of return to work. And so this will be an important thing to watch. If we start to see layoffs ticking up, if we start to see slower job growth and higher continuing claims, that could have an impact to the economy and a potential slowdown. And that's where the Fed may be more aggressive with the rate cuts and maybe moving a little bit more rapidly.
Well, and recently you've seen a number of job cuts. The JOLTS job cut survey showed the largest January cut since 2009, 108,000 jobs. So there are signs that you could see more cuts, but to your point, overall, it hasn't been a major issue. And again, I think that one of the big things to follow this year is the US dollar, right? And the US dollar, which has been, weak over the last year, if we look at the dollar versus the euro, I think there's a lot of reason to watch the dollar because I think there's big implications to your investment portfolio and where to rebalance within your portfolio this year. And again, if you look at the chart of the dollar versus the euro, a year ago, it was roughly pretty close to one, the dollar versus the euro, whereas today it's 118. So over the last year, you've seen a substantial depreciation of the US dollar. And if you think about the implications of that weaker dollar, to me, it reminds me a little bit of the period from 2000 to 2010, which was the lost decade for the S&P 500, where during that period, large cap US stocks basically returned negative over 10 years. Obviously, there were a lot of ups and downs during that period, but the trend for many of those years was a weaker dollar. And what that did, international stocks performed very, very well during that time frame as well as small companies and mid-size. So a rotation within the market. The other thing with the weaker dollar, a lot of the multinational large cap companies, as they bring their overseas profits back, and many of our large companies have half or more of their revenue overseas, it's going to be a headwind to earnings. So I think there's good reason, as we mentioned, international stocks were the top performer last year. They've started the year as the top performer, and as you look at that dollar potential weakness continuing or holding these lower levels, that could continue to be a boost. You saw this morning, European Central Bank left interest rates alone. They mentioned the strong euro could continue to hold inflation lower in Europe overall. So there's good reason to consider continuing to move up international allocations, and it's more of a multi-year trend. Same is true with commodities. We've talked about the dollar relative to copper, gold, silver, you name it, and some of these metals have been in a very speculative state over the last few months. But again, I think the huge upswing of the underlying commodity prices might be over. But, the underlying companies that hedge those commodity exposure, I think could do fairly well as some of those hedges, roll off and they're able to achieve some of those higher underlying commodity prices.
Yeah, Jared, looking at the kind of overall U.S. economy and just S&P 500 and earnings overall, we're kind of a third, maybe half of the way through earnings season. I've seen some results. What's your take on kind of, a lot of these companies outperforming their expectations? 65% of the companies beat on revenue, 75% beat on earnings, but you haven't seen a significant move after that. What do you think is driving some of that?
Well, and as we talked about coming into the year, we expected more of an uneven performance within the market, especially within big tech. And that's been the case. And as you mentioned earlier, it's kind of chicken and egg, right? These companies, it's been in a positive momentum the last 2+ years where pretty much everything goes up together. Now, with between valuation, maybe a little bit slower growth rates, could continue to be a headwind, and there's just better opportunities. So I think when you look at portfolios as we've done to start the year, you take some profit in some of the positions that have done very well over the last few years, continue to stay, diversified overall. I think this is going to be a year where diversification continues to help portfolios overall as you grapple with that chicken and egg, even with good results from revenue and earnings, has your underlying valuation already priced that in for many years to come, in some cases. And I think that's likely what you're seeing within the market is these have performed magnificently over the last few years. And even if you beat your results, there's better opportunity within the market. And I think continue to be diversified. Valuation, we believe, is going to matter a lot this year, whereas before last couple of years, it's been more about momentum. I think valuation will continue to be a big factor in what performs well this year.
Yeah, and as you kind of mentioned, right? So with some of the just some of the activity in the market, right? And small cap potentially benefiting as it did better in some of the periods of time you mentioned, like in the early 2000s. But again, as you look at the overall landscape, the overall U.S. economy continues to do well, and earnings have been good. But as companies look again for future earnings, I mean, that's where M&A really picks up. We've seen a healthy M&A pipeline, a number of deals coming to the market this year, and also some of the smaller mergers and acquisitions where you see companies maybe purchasing a smaller competitor or somebody in their space to vertically integrate. And that helps drive the performance in the small cap sector, helps some of these larger companies buy the growth that they may, as they see it, slow down. S&P 500 earnings growth was 12% over the last year, so very healthy earnings growth. But the key is the growth rate, right? So as you're growing at 12% and then 11% and then 10%, all of a sudden the market starts to adjust valuations, and that's where companies look to acquire more.
Well, on top of it, as you look to the rest of the year, I mean, you've seen a lot of concentration in ETFs, sector ETFs, you name it. Software comes to mind over the last week, right? And there's concern that AI, as it continues to advance, could and will replace, some or all of the software sector. So you've seen a concentration of shorting the software ETF. Everything goes down that happens to be in that ETF. On the other hand, it opens up opportunity, maybe cybersecurity, some of these other areas. And again, I think with all the whipsaws in the markets and the concentration within the market, that's going to continue to open up opportunity, that's going to unfold as certain companies are overdone to the downside. So despite the fact that you continue to see, some rebalancing aggressively within the market, there's going to be opportunity and continue to be. But I think as we look to, February and the rest of the year, diversification is going to matter. International is likely to continue to do well. You mentioned the M&A financial sector and other areas, there could be opportunity, and we'll kind of see where things play out from here. So with that, I want to thank you for tuning in. We'll touch base next month.
Thank you.